Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Chi Hathiramani. Chi is the CIO of Upside Avenue in Austin, Texas. What the heck is Upside Avenue? Upside is a REIT, or a real estate investment trust, that invests into multifamily properties located in high growth geographic areas, carefully selected to mitigate investment risk. Multifamily real estate investing was once only available to commercial or high net worth individuals, and Upside Avenue lowers this barrier for individual investors to invest with as little as $2,000. With attractive 10+% yields, especially in these days, in this conversation we dive into why multifamily real estate investing might make sense for investors and go into detail how it works when investing with Upside Avenue. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. This really helps people find the podcast and keeps this thing going. It really helps. Thank you. Okay, let's learn something about multifamily investing. Enjoy this conversation with Chi Hathiramani. Welcome, Chi. Welcome to the Alt Asset Allocation Podcast. Super excited to have you on today.
Likewise. Thank you so much, Ben. Such a pleasure and blessing to be here.
Yeah, you're in Austin right now?
That's right. Yeah. Yeah.
Yeah, so we are just catching up a little bit before we started, and I'm excited about what you're doing with Casoro Group and Upside Avenue. But before we get into that, I just wanted to start off a little bit about your background, who you are, and how you got involved with multifamily investing.
Yeah, sure. So it goes back to me being born and raised in the Philippines and coming to the States for undergrad. I got a degree in real estate, moved to DC, went to go work for a publicly traded REIT called Vornado Realty Trust, which is an office-based REIT, about a $30 billion shop. Spent about 10 years there working in acquisitions. And so, with working in a shop like that, I got experience in a multitude of asset sort of classes in real estate, office, retail, multifamily, a little bit of industrial, and some ground up as well, experience along the way. So that's sort of the basis of where I came from. And then I met my wife there, and we moved to Austin and picked up some student housing experience along the way, and now specialize in the multifamily segment at Casoro Group.
Awesome. And just so we're clear, when you say multifamily, what exactly do you mean? What does this mean to you?
Sure. So technically, from what I understand, the definition of multifamily is five or more units of apartment units, right? So we specialize in a class that's larger than that. We focus on institutional multifamily, which is generally 200 or more apartment units. So it's typically, as you're driving down the street, those communities, the fenced-in communities you see, those are really what we focus on from an investment perspective.
Okay, and I mean, you've had experience with a number of different classes within real estate. What is so attractive about multifamily, and especially these like mega multifamily investments that you're making? What attracts you most to this asset class or subclass, I guess?
Absolutely. It's really interesting now that we are sort of this is we're recording this in a COVID environment. You can really see where multifamily shines. Everybody needs a roof over their head. Whether you own a house or an apartment, it's a decision to be made. But everybody needs a roof over their head. So multifamily has demonstrated itself as an extremely resilient and sort of cash flowing asset class sort of in this environment. And I think that's what attracts us to multifamily. It's very stable cash flows, and unlike sort of office or retail, those those product tend to have tenants that come and go in large batches. So you might have an entire office building leased to one tenant, like a tech company or something like that. And when they go, you lose all of your income. You know, versus multifamily, it's a diversified base of income. So even unlike single family residential, if you have a resident living in one of your homes, when they leave, you're basically footing the bill for the mortgage and the utilities and repairs and all of that. With multifamily, when you have 300 apartment units, it's a very diversified stream of income which you can manage and grow. So that's really what's attractive.
Gotcha. Yeah, and I think that potential for scale and management at scale is one of the most interesting aspects, especially for me, for multifamily, and to reach that, the operational need of managing, 10 or 15 single family rentals. That sounds like a nightmare to me. So you can have one property management company, one big roof over all of them, sort of thing, and streamline that quite a bit. So those are some of the advantages. I get that. It's like instant diversification. You have a number of different tenants all paying you income. So if you have vacancies, but what are some of the disadvantages for an investor holding multifamilies versus some other options within real estate?
Yeah, obviously, with scale comes the challenge of managing a far more complex enterprise. A real estate community is not just a physical sticks and bricks. It's also the operation of, call it, 300 residents, having vendors, having professional on-site teams that manage it, having construction going month in, month out, for an entire year because residents are coming and going. So it's running a company at that point. When you're dealing with multifamily, and I think it's that scale that when you know what you're doing, that competency and professionalism pays off in multifamily. But if you're really looking for a passive investment, it's going to be tougher, or if you're trying to mom and pop it, as what we say, it's going to be tougher to manage, an apartment community of any scale.
Yeah, and that makes sense. But I mean, some of these smaller, like, so you take a 5, 6 unit multifamily. I mean, for an investor that has the option of buying 5 or 6 single family rentals, or perhaps one multifamily with six or eight apartments in it, kind of walk me through the decision process, the pros and cons of each, if you would.
Yeah, sure, sure. So there's a couple different things. There's sort of the renter's profile. With an apartment renter profile, they're more transient. They're coming in and going, right? They're professionals that are looking for maybe, on average, we say 2-year tenancy. When you're renting out a house, it typically tends to be more families. They're looking for a 3-bedroom, 4-bedroom house generally, and they're there for the school districts. They may have kids, so it's just a different profile from that perspective. So one of the benefits I think of single family rental is really the longevity of the renter base. But with multifamily, sort of you can get more rent per foot, we call it, for every square foot that you're leasing. So there's that opportunity from that perspective. There's From a single family perspective, I think you're more focused on what we call sales comps. So it's basically what are other houses in the area selling for, and that's sort of where you're limited. If your house is worth about $400,000, that's sort of what it's worth. With an apartment community, you can buy an apartment complex for, let's just call it, also $400,000, but do all sorts of things to improve the resident experience. So you can add washer dryers to the units, you can increase the rent, and by doing that, you increase what's called NOI, net operating income. And given the way multifamily trades, it trades more like commercial real estate. You basically get a multiple on that NOI, or we call it a cap rate in this case. So with that, you can sort of force value creation. So that's another sort of difference between the two. Now, I think I do own rental houses as well personally, in addition to having made investments in multifamily, and they're just different from a single family perspective. It is nice to know that you can drive down to the house and it's all yours. And if you ever need to sell it, one of the benefits of single family homes is liquidity, right? You can basically post it on the MLS and get that puppy sold in 2 weeks if you're in a good market. Multifamily, not so much. Now
And
yeah, go ahead.
and the lack of liquidity is more that it's just serious investors that are buying these multifamilies, as opposed to, I want it because the yard looks nice, sort of home buyers, right?
Right, right. Yeah. The transaction timelines are longer. The diligence is longer, right? You go far deeper when you're spending $10 million of equity into a deal rather than 5% down on a $400,000 house. So there's that little differential there, and there's a fiduciary responsibility as well, which is so important, right? For us being sponsors for our investors, we have a fiduciary responsibility to treat their money at a much higher standard that we would our own money. So I can't treat it like I would my own personal money, right? The standards are just much higher. So that adds a layer of complexity as well.
Makes sense, yeah. Casoro Group, you guys have been doing these mega multifamilies for a number of years. What fundamental risks do you see to the multifamily investing thesis? I mean, so I'm hearing things, with Corona, this is being recorded late August. people want to get out of the cities and have more space. So, and I mean, maybe this is just a phase, but is this a fundamental risk to the let's have a giant multifamily, stock it full of amenities, maybe a little bit of extra space, but like, would help me think through this
Yeah,
kind
sure.
of systemic risks here.
Sure, sure. So, interestingly enough, I think if I include student housing and senior housing as sort of categories within multifamily, it starts to paint that picture more clearly. So, conventional multifamily, which is sort of the space that we play in, has fortunately done very well, and we think it's done very well during the Corona time period because of sort of stimulus, the CARES Act, the HEALS Act, and all of that have really propelled by giving money to renters. It allows them to pay rent, right? So that's really propelled sort of the multifamily, the conventional multifamily industry, to the extent that actually right now fundamentals are even better than they were pre-COVID. Not by much, but I mean, properties were already doing, multifamily was already doing very well. They're only doing a little bit better. But where you're actually starting to see the contrast now is with student housing and senior housing. So with student housing, because you know universities are shutting down effectively and going
Nobody's
virtual.
in them because they're not going to school,
Nobody,
right?
students are not coming back to universities, and we're starting to see sort of the cracks there. Same thing with senior. If you've got mom and pop living at home and it's time to move, a parent into sort of a senior housing facility, you're going to think twice at this point, right? From a safety perspective, and that's what's actually happening in the senior housing industry right now, where they're well occupied, but there's very slow moving into it. So it really depends on which sub segment you are of what the world we call multifamily.
Yeah, and that makes sense. But even with the traditional non-student, non-elderly multifamily, I mean, it sounds like this is propped up by the stimulus and free money, right? So it's like as soon as this runs out, which is debatable if they ever turn off the faucet, I suppose. But as soon as, in theory, it runs out and they stop paying this, I mean, are we going to see mass exodus from multifamily people into rural areas? What is kind of your thoughts on these macro trends?
Right. Yeah, I think, and that's obviously the concern that we think we're going to face in 2021 is, well, what actually truly happens? But the truth is, it's sort of counterbalanced by the fact that people need a place to live, right? So it's not so much that they're just going to move out in mass exodus. It may be that they can't afford to pay rent for a month or two, or we have to work out a payment plan with them, right? So that affects multifamily fundamentals. But the question is how much and how long. Internally, just we're obviously watching the markets closely, but we think 2021 is probably going to be a choppy year for everybody. But by 2022, we expect things to be back to normal. So and the question is, okay, well, how do you handle that? How do you ride through that? The reality is that multifamily or real estate in generally is best played as a long-term investment because there's so many frictional costs getting in and out of a deal. It's you're best served holding it 3, 5, 7, 10 years. That's really how ultra high net worth families invest in real estate for a decade plus, right? So it depends on your strategy, really. Yeah.
Yeah, and I think that's a very good point. So even if there's some near-term pain, I mean, what's your longer-term 10-plus year thesis? Does this make sense? And that should be driving the decision to invest or not. Um, I'm curious. So, Casoro and Upside, you operate only within Austin area?
We actually operate within, well, we operate
Oops.
within Central Texas primarily. And we do have some investments outside of Texas, but we are generally sharpshooters in Texas. That's what we're known for. When it comes to institutional investing, your LP, the passive investor in our deal, wants to know that we actually have the operational expertise and that we're targeted in the areas that we work, right? So we do Dallas, Fort Worth, Austin, San Antonio, and Houston. We own about 5,500 units today. So it's about 19 properties, generally all institutional, and operate in that arena. We're also vertically integrated as a sponsor, which means that we have everything from sort of property management, construction management, asset management. We have a general contractor affiliated. We do utility billing, green improvements, all of that sort of in this ecosystem of our companies, that creates this value add opportunity.
Yeah, that makes sense. And actually, I just had a podcast guest on, Mark Podolsky, and he said one of his mentors had said, when you're a kid and you're burning ants with a magnifying glass, if you're moving that glass all the way around, you're never going to burn the thing, right? So you got to really focus on that ant and keep that magnifying glass in the same spot. And it's seared into my memory that
That's a great.
if you're always chasing all of these other things, like you guys, I mean, you're a sharpshooter in Texas, the market, so you focus on your competencies and double down on your strengths there. So I get that. I'm curious, in Texas, I mean, Central Texas is a big area. So what factors are you looking at before going after a development? What kind of demographics, population, job growth, like all of these factors that are kind of most important when making these investment decisions?
Absolutely. Yeah, we're obviously focused on location, right? And fortunately, Texas has been sort of one of the largest in-migration states, right? It's got like what 30 million people today, 29 million people, and it's just continuing to attract folks from the West Coast, East Coast, northern states, et cetera. So generally speaking, Texas has been great. Now within Texas, we focus on the largest metro areas, which is in and of itself a security blanket because it creates liquidity and basically the mass of the urban scale in any of these major cities basically gives you a large enough renter pool such that you're probably not going to land up in a situation where one employer leaves and you're kind of out. So location is very critical. But I'll take Houston for an example. It really depends on where you are in Houston. Whether you're
Oh
sort
yeah.
of in West Face or you're in Greens Point. Just and I don't mean to get too specific here, but your submarket and you're half a mile block from the next place really does matter as to where you chase. Uh, so we're focused on sort of location specific, neighborhood specific. We look at the schools, we look at the home prices, we look at the average median income, right? The demographic of the folks. We also, when we dig into an asset, we study their rent roll, we study their the physical condition very very acutely. Because those things really matter, right? The quality of the income that you're getting from the asset matters, and also the quality of the real estate itself and its ability to attract people that will pay you that income. It also matters, right? So those are some of the key factors that we're looking into. There's obviously a myriad more, but those are some of the big ones.
What are some of the glaring red flags? You go into a market that maybe ticks the box on some of these, but what kind of jumps out and it's a no go? Like, are you looking at water availability and things like this, like super long term?
Fortunately, in the inner city, water is tends to be available. What we would be considered about is floodplains, like Houston. Your flood insurance can be surprisingly high in Houston. But yeah, red flags generally you're looking both to the market, submarket, and also to the property itself. So from a submarket standpoint, we want to make sure that the property is sort of well located in the submarket. The submarket is performing. When you drive around the neighborhood, you want to see that people, places are kept up well. Retail is doing well. Generally, businesses and services are humming in an area. That tells you this is a vibrant and it's a strong area in which the people that live on your property are probably going to be able to find jobs in the area, and that's what attracts it. When it comes down to the property itself, you're looking really to the physical asset itself. What's the quality, what's the condition, what's the curb appeal, how well has the equipment been maintained. And one of the big things with sort of value add properties that we deal with is that they're a little older. They're like 1980s, 1990s, sometimes even 1970s. And so you have to consider things like the roofs, the parking lot, the HVAC units, the air conditioning units, right, inside and outside the property, the water heaters. Like these things could be really large capital items from that perspective. You also want to see the resident base, the quality. Are they actually paying, or is there a lot of delinquency at the property? Are there key signals that tell you, hey, this resident base, the prior management or the prior owner has not really done a good job either screening the residents or teaching the residents how to live at this community. Those things could signal some pretty big flags once you take over. Now, at the same time, those things also create opportunity for upside, right? Because that indicates, generally it goes hand in hand, that the property is not actually being maintained that well, not being operated that well, and that's really part of the upside story. But
Yeah. Yeah, that makes a lot of sense. So, I mean, what does a perfect investment, a multifamily investment opportunity look like? I mean, obviously, you make most of your money when you buy, so at a great price. But besides that, what are the massive levers you can pull right off the bat and force that appreciation, get a lot of value right off the bat?
Absolutely. Yeah, we look for properties that have definitely operational and physical upside. And I keep coming back to that, but that's really where it's at. Because the operational upside is really, you're looking for revenue generation, you're looking for expense savings, and you're looking to control taxes and insurance and those kinds of factors through sort of long-term planning, right? And then from a physical standpoint, you're saying, what kind of dollars can I put in to actually improve the quality of the property? Can I add, can I upgrade the amenities? Can I upgrade the fitness center? Can I upgrade sort of the entire landscaping? All of the features that when a resident drives up to the property, they find really exciting, and the user experience grows, right? And then there's other aspects like safety, creating a sense of community. So community programs. Those are all the things you can do from an operational standpoint that really make a resident, uh, want to live at your community. Now, as a company, our vision is to create better homes for better lives. And we believe that that's our company vision and our motto. We take that very seriously. So when we look at a community, we look at all these different aspects. What's the safety look like? How are our residents doing? Can we create a sense of community? Can we give them access to financial resources and other, training and after school programs? Like, what can we do to make their experience better, so that they want to stay? When residents stay, we call it retention. When you have higher retention, you will find that your NOI will automatically go up, right? There's just a lot of things that they do right. When residents are very happy, they tend to pay rent, right? They don't skip. They don't ask for, push for concessions. They don't leave the units, which means you have a lower turnover expense. All these things just improve NOI, which ultimately improves property value, increases property value.
Yeah, that makes a lot of sense, and I mean, retention is a huge thing, especially in these gigantic multifamilies. So, what trends are you seeing here? I mean, increased importance of amenities, increased sense of community, increased open space. Like, what are kind of the bigger trends with that you're seeing to increase this retention and make people be happy in these living situations?
Yeah, I think the old playbook, pre-COVID playbook, is sort of out the window at this point. And right now, with everybody working from home,
With everything, right?
with everything,
With many
right?
things.
Yeah, yeah. With all of this, our residents are going through a tremendous amount of strain, right? This is a different world. So being there, really creating a sense of community and community services, and being responsive to them, meeting their needs for maintenance and just general care, seems to be the most important thing we can do, and that actually is our highest priority right now. It's sort of back to basics at this point. It's uh, the whole push for how can you have the highest amenities, the $500,000 sort of, playscape outside. I mean, nobody's going outside. There's sort of that. So we might see the resurgence and recovery of sort of those amenities, but at this point, it's coming down to basic care, and just showing that you care about your residents. That's becoming the key point.
I know Casoro and Upside cater to a different audience with more institutional interest, but in terms of smaller investors within the multifamily investing space, what are some of the biggest misunderstandings or hurdles that they face when going into this world?
Yeah, I think potentially, and this is what we see with Upside Avenue. There's quite a steep learning curve for folks that don't understand institutional real estate. You have to understand things like timing of your investment, when things get paid out. Why is there a 3 or 5 year hold? Why does my money need to be locked up for a certain period of time? Why am I being charged the fees I am? All these things are sort of critical components to understand. They're different in institutional real estate. Timelines are longer, value creation processes are longer, but at the same time, they're also more resilient. They're more robust because the scale of which you're dealing with and the professionalism of all the teams involved tends to or it tends to ensure, really, I can't guarantee anything, but it tends to ensure a better outcome. But at the same time, things do take longer, and you're part of a bigger process at this point. that's something that people really need to understand. Yeah.
Okay. Yeah, and let's dive right into it. So, pitch me upside what it is exactly you guys are doing, the value you're creating, and then we'll dive into more of the details.
Yeah, sure, sure. So Upside Avenue is a real estate investment trust, which basically is a type of it's a type of ownership entity style. It's a diversified fund, really, is what it is. So Upside Avenue today owns about a dozen investments, and so it's a way for somebody to come in with less than institutional cash, right? So at Upside Avenue, the minimum is $2,000, so you can come in and invest alongside Casoro Group, which is our entity, the real estate investment company's entity, into institutional deals and sort of participate on that institutional side on these large deals. That's really what the vehicle does.
It's a private REIT, essentially, right?
It is, yes, it's actually public, but non-traded. So it's not on the stock exchange.
Public, non-traded.
Publicly traded REIT. Yeah, that's the
Gotcha.
way.
And how many assets under management, or how do you kind of measure this?
Yeah, sure, sure. So the REIT's made about a dozen investments to date. That's sort of our metric at this point.
But so net asset value, is that a public number then?
Not at this point.
Okay, so Upside Avenue offers you the ability to invest alongside this institutional capital in these multifamilies that you would never be able to invest in otherwise, well, unless you had a spare couple $10 million sitting around. So with $2,000, you can get involved. Uh, Something you had mentioned earlier that is a big difference for investors is lockups, fees, timing. Timelines are longer. Can you just touch on some of these then?
Yeah, absolutely. Yeah. So I think maybe the best way to understand it is, so you invest in the REIT, call it 2,000 minimum. Actually, many of our investors are 7,500. We've even got a $500,000 investor in our REIT. But generally, what happens is, so you invest in the REIT, and then the money in the next quarter gets invested into sort of the pool of capital available for the REIT to then deploy into real estate. So then that happens shortly thereafter, right? At which point you're already starting to basically get your cash and cash return. And I can explain where the components of return come from. So then that money sort of gets invested into the pool of real estate that the REIT owns, which today is about a dozen assets. And then you receive a cash and cash return every quarter, right? And then obviously when an asset sells, then the return from that gets returned back to you as a shareholder in the REIT. So that's sort of the standard structure of how the investment works. Now, from a fee standpoint, the parent company of Upside Avenue charges a 2% asset management fee on the equity. So there's that fee. There's also a small disposition fee on the back end, but that's not always charged. I think we've also, depending on the structure of how the REIT makes an investment with Casoro Group into a deal, it may or may not get a disposition fee. So we may not charge a disposition fee at the Upside Avenue level. So generally, for the most part, the fees really are just the 2% sort of asset management fee.
And there's no performance fee or anything like that.
No, actually, that's one of the key differentials here is we don't have some back end promote or something like that scrapes a lot of the return of the investor. It's quite literally that. There is an administrative fee just to manage the REIT, paid along the way as and when possible, but it's not significant, right? So it's really the 2% the 2% equity management fee is really where Casoro Group sort of earns its keep effectively, or sorry, Upside
Yeah.
Avenue earns its keep.
Yeah, I mean, the only problem with a flat fixed percentage on management is how can you ensure that the incentives are aligned? Because fixed implies that the incentives are to grow the pool of investable assets less than, a asset appreciation, I guess. So how would you address a
For
question
sure,
around
yeah,
that?
and obviously, number one is our reputation, right? It's backed. Upside Avenue is backed by Casoro, which is an 18-year company that's delivered, outstanding returns really in the industry. So you've got reputation. But the second is, in order to raise more capital, as we discussed, you have to deliver the returns. And so Upside Avenue has and does deliver that returns and is expected to deliver those returns, right? The moment we don't, I can break it down for you. We basically tell investors that we're looking to generate a 4 to 7% sort of range of cash on cash return per year plus another 6 to 8% of appreciation. So for a total of about a 10 to 15% return per year, right? Now, if we start moving away from sort of that range, particularly on the low side, we won't be able to attract capital. So that sort of keeps us in check.
Okay, and 10 to 15%, and that's with both built in. Um, is that net of the fees, or then you would be
Correct. No,
minus
that's
the
net of
2%?
fees. That's
Okay.
net.
And then, so for an individual investor, so say I invest in this non-public or private, public
Public non-traded
non-traded
REIT.
REIT.
Yeah.
Yeah, almost got it. Public non-traded REIT. How is this how are these returns treated for me, the individual investor? And disclaimer: this is not investment advice. Seek professional advice. All of that applies, obviously, but just higher level. How would it be treated?
Yeah. So again, yeah, that's absolutely a good disclaimer. I would suggest you talk to your your tax advisor and your CPA. But there's obviously an ordinary income component or a dividend income component, which may be portfolio income, and then there's long term income from capital appreciations at sale.
Okay. And then you talked as well about lockups and timing and timeline. Can you address those as well?
Yeah, sure. So there is a when you make an investment into the REIT, there's an assumption and expectation that this is a long-term investment, right? So the money gets deployed immediately into real estate. So the way we handle it as Upside Avenues, for the first year, you're basically locked out, and then in years 2 and 3, and I believe 4, there's a declining scale of fees, effectively. So I think it's in year 2 it's 2%, year 3 it's 1%, and then from year 4 it's basically at par. So that means, there's no cost to take out your money after that.
After 3 years.
After 3 years, yeah.
That's pretty low, right? I mean, these investments should be really long-term investments. If I
That
can pull it out and have liquidity with no impact after 3 years, that's a differentiating factor, and I would think, correct?
Yeah, we actually absolutely, and we believe the same. In fact, the way we look at it is basically if you're clipping a 5% cash on cash in year one, if you had to take a 2% hit uh, on your principal, basically going out the 2% fee, you're still net positive by the end of the first year. So it's just it's but again, that's never the intention, right? The intention is we're looking for investors that are looking to make long-term investments, because that's where you make your money in real estate. As with anything, really, like the compounded interest, the compounded rate of return, goes up substantially, dramatically. That's how you make more money the longer you keep your money in a high yielding asset class.
Let's dive into this a little bit more deeply. So the net asset value is just the total value of all the assets, all the multifamily properties that Upside owns as a REIT,
Mhm.
divided by the number of shares outstanding, right?
Correct. Correct.
And then that is revalued every year or only on time of sale of these properties.
Right. Yeah. So Upside Avenue is a relatively new REIT vehicle. So it's been around for 2 years. So at this point, we're still not marking to market. We expect to do so once we had a certain minimum sort of corpus of assets in the REIT. Maybe 10 more assets, I think, is what we're looking at before we start to value the REIT on a share basis. So at this point, the REIT has not really truly exited any of its equity investments. So it's still sort of building up. And as that happens, investors start to get payback, and then the share value also will start to get pegged, basically marked to NAV.
So if you exit early, say after 3 years, I'm missing out on that capital appreciation, or no, if you're marketing it to market every year, in theory, I would be capturing that, correct?
Correct. Well, once we start marking the share price to NAV, absolutely, that's exactly the mechanism. You just need a certain amount of assets to start to make the mark to market feasible. So at this point, basically, yes, it's a fixed price. It's $10 a share. But in the very near future, as soon as we scale up the portfolio large enough, it's going to start to move, basically with asset value.
Okay, and then the redemption process after 3 years, I'm selling this to another investor on the platform, or I'm selling it back to Upside Avenue itself.
At this point, you're selling it back to Upside Avenue.
Okay, I was making sure there
Gotta go.
wasn't a pool of extremely limited liquidity, but yeah, you can sell. Good luck, sort of thing.
No, we've honored redemptions. So we've had a few investors, thankfully not much, but some folks obviously with the COVID environment have had changes in their circumstances. So we've honored a few redemptions.
And so what kind of investor should be interested in something like Upside Avenue? I mean, who's kind of your ideal investor here?
Sure, yeah. So we're looking for, someone who wants long-term exposure to sort of the real estate asset class, and more particularly institutional real estate. Someone who's looking for sort of those good steady returns and that good, the appreciation that a large pension fund would be looking for, or a large private equity firm would be looking for. So that's sort of the investor. They just get to participate at a much smaller dollar amount, but it's effectively the same strategy.
Right. Yeah. No, it's definitely a value. I mean, tremendous value. Like I said, I don't have a spare $10 million sitting around to have this sort of asset sitting in my portfolio. And even if I did, then I wouldn't be very diversified. Now, would I if I only owned that? For
Right.
somebody that doesn't know much about the Texas economy, multifamilies in Texas, I mean, what fundamental risks to the real estate market in Texas do you see?
Yeah, it comes back down to sort of employment trends, job growth trends. For example, one of the risks occurring in Texas right now to Houston is because of the basically the oil crash. Right, you've had a lot of it's created an energy crisis in Houston again. We just had one, 5 years ago, 5 6 years ago, and we're back at it again in Houston. So you really need to look at, for every city in any state, really Texas or anywhere else, what the migration patterns are and what the job growth patterns are. um, Now, Texas being so heavily energy dependent, at least on paper, I think a third of the economy, if I'm not mistaken, has some tie to energy. You've really got to look at that. If you're in Washington D.C., it's the government. If you're in New York, it's the financial sector, or the other, various other things. Obviously, these are all diversified economies, but those are some of the key things to be looking at.
Yeah, yeah, that makes sense. I mean, those are the key drivers, and that's keeping everything else afloat. Um, awesome. Well, this was really helpful, and I think thinking through, I think multifamily makes a lot of sense in a lot of portfolios. So I think Upside Avenue is offering a lot of value to investors to get in at a lower dollar amount. What else? What do you want to leave my listeners with? Where can they find out more about you, about Upside Avenue? What do
For
you want
sure.
to leave them with?
Absolutely, yeah. So, obviously, we'd you can find more information on our website at upsideavenue.com, and that's for the REIT. And then, the sponsor of Upside Avenue is really Casora Group, which is the company with sort of the track record, the in-house management expertise, the vertically integrated structure. So that's casoragroup.com. One of the differentiators between sort of Upside Avenue and some of the other crowdfunding or retail funding websites on the internet is, you really got to look at who's backing it, who's sponsoring the investment. Is this a technology company that is raising money and pumping it into real estate, or is this a real estate company that is raising the capital for its deals? So there's a very different sense. We come from a legacy of actually, tried and tested, boots on the ground real estate investment in Texas. So that's what I'd like to leave it with.
Awesome. And actually, one more question. Sorry, the roadmap. So you want to get 10 more properties. These will continue to be in Texas, continue to be in multifamily. What kind of excites you most about your roadmap going
Oh,
forward?
that's a great question. So, in our vision of creating better homes for better lives, we also do want to grow the company tremendously. So, we have 5,500 units today. Our target is actually 20,000 units across the entire Sun Belt. So, the REIT is a vehicle designed it has a mandate that allows it to do that. So, the REIT can invest in conventional multifamily, senior, and student housing across the Sun Belt. Obviously, given the dynamics of what's going on today, we're probably going to continue to focus on multifamily in Texas as we grow and scale up the platform over here. But eventually, this is going to be diversified across the entire Sun Belt and across multiple segments of the multifamily space. So that's where we're headed.
Awesome. Awesome. Really exciting. Well, I'll link all of these things in the show notes, but really appreciate it, Chi, coming on here and spending all the time talking about this.
Well, thank you so much. Really appreciate the opportunity.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.